Hi everyone, Demir here from Westmount Wealth Management. Today we're diving into one of the most overlooked wildcards in retirement planning, sequence risk. Sounds technical, but the idea is rather simple. It's not just how much your portfolio earns, it's when those returns actually show up. Picture this. Two planes leave the same airport on the same day headed towards the same destination. One catches smooth skies and coasts in ahead of schedule. The other, just an hour earlier, hits turbulence, burns more fuel, and the passengers are gripping at their armrests the whole way. Thankfully, both planes in our scenario land, but the rides couldn't feel more different. Retirement can feel the same way. Two investors can have the same savings, same portfolios, and same withdrawal rates, but if one hits rough markets early on, their journey can look very different. Most investors think in averages. If a balanced portfolio returns 5% on average over the long run, they plan around that number. But the problem with averages is that they hide the path. When you're still saving, an early downturn is actually great. You're typically buying more shares at bargain prices. But when you retire and start drawing down, the math actually flips. Losses early on can result in permanent damage because the withdrawals lock them in, and this in turn can permanently shrink the base that your future growth relies on. Let's rewind to the beginning of the global financial crisis. Picture October 2007. Two retirees each start with $1 million portfolio, withdrawing 4% a year, i.e. $40,000 each year, adjusted for inflation throughout their retirement. A balanced 60-40 portfolio takes some hits along the way, but fully recovers in about 6 years and ends 2024 at about $1.35 million. An 80-20 growth portfolio recovers in just over 7 years and lands in the same ballpark, but with more drama along the way. An all-equity portfolio, the go big or go home approach, finishes lower at $1.23 million and takes 13 long years just to get back to break even. That's a lot of sleepless nights. Now, let's raise the stakes and push the initial withdrawal rate to 6%, i.e. $60,000 a year. That's when things get rather ugly. The balanced portfolio is nearly cut in half, ending with about $563,000, and the all-equity investor, well, they're down to about $233,000, less than a quarter of their initial capital. That's not a nest egg anymore. That's more like a cracked shell. Here's where the story gets rather wild. Change nothing but the retirement start date. So one person retires in October 07, right at the onset of the global financial crisis. The other retires in March 09, right near the bottom, i.e. the start of the recovery. Again, same $1 million, same withdrawal rates, same portfolios. By the end of 2024, in a balanced 60-40 portfolio, the unlucky retiree ends with $1.35 million, the lucky one with $3.83 million, about a $2.5 million gap. In an 80-20 growth portfolio, 1.35 versus 4.93, about a $3.5 million gap. And then the all-equity investor, the difference is 1.23 and 6.28. That's a $5 million swing. To reiterate, same withdrawal plan, same rules, just different timing. It's like two people buying the same lottery ticket and only one of them cashes in. So for someone still saving, volatility is really just background noise. But once you're retired, it's front and center. Portfolios in retirement typically don't have the luxury of decades to heal, which means retirement planning isn't about hitting the absolute highest returns. It's about narrowing the gap between best and worst case scenarios. Put simply, making retirement less like a coin toss and more like a flight plan. So you might be wondering, well, that's just great, Demir. You're basically telling me my retirement is a coin toss. Not quite. At Westmount Wealth, we don't just cross our fingers and hope, that we catch tailwinds. We design strategies for real-world retirement. Some of those strategies include things like a cash wedge, right? So that's setting aside a few years of spending in cash or in short-term bonds, so you're not forced to sell stocks in the middle of that storm. An additional approach is dynamic spending, which relies on separating your must-haves from your nice-to-haves. So lifestyle can flex a little bit in down years without actually, blowing up your retirement plan and hurting your quality of life. Furthermore, diversification. We harp on this quite a bit. Think about it like adding extra engines to your plane. By diversifying across sectors, geographies, and asset classes while adding exposures that behave differently across different market cycles, We aim to narrow the possible outcomes and provide our clients with an improved likelihood that they will achieve the lifestyle which they seek. Lastly, we do a lot of stress testing and simulations. We run hundreds of what-if scenarios like inflation spikes, longer lifespans, and lower expected returns, so clients know that their plan can handle turbulence when it eventually does occur. These aren't theories, they're practical ways to shift outcomes away from luck and towards resilience. Now, here's the bottom line. The first decade of retirement is fragile. No one can control markets, but you can control how you prepare. Sequencing risk can't be erased, right? But it can be managed with smart planning, discipline, structure, and the right strategy. So think back to the airplane. Retirement isn't about hoping you catch the perfect jet stream. It's about building a flight plan that gets you to your destination safely, even if the skies get rough. At Westbound Wealth, our goal is to reduce the role of luck and maximize the role of preparation, so clients can retire with clarity, confidence, and a smooth ride. Thank you once again for watching, and as always, if you have any questions, you know where to find us.